Welcome to This Explainer. Today, we're diving into something really fascinating and honestly a little terrifying. We're going to look at the hidden mechanisms buried deep inside our global markets. Specifically, we're talking about how invisible leverage creates this massive systemic fragility. It acts just like a hidden tripwire, and it can literally topple the entire financial system before anyone even realizes it's there.
We've got to start our investigation with this absolutely jaw-dropping number: $20 billion. Just take a second to let the sheer scale of that sink in. We aren't talking about the GDP of a small country over 10 years. No, this represents the exact amount of money a single, relatively unknown family office just evaporated into thin air. And they did it in just 2 days back in March of 2021.
So that firm was Archegos Capital Management, run by a guy named Bill Huang. And when Archegos suddenly defaulted on these massive margin calls, the entire financial world was just left completely stunned. It wasn't only the immense scale of the meltdown that shocked everyone, it was the terrifying speed. Billions of dollars simply vanished over a single weekend, leaving some of the absolute biggest, most sophisticated lenders scrambling to survive.
Okay, let's quickly hit our roadmap for today. Part 1, the $1 billion Vanishing Act. Part 2, Anatomy of the Leverage Cycle. Part 3, NBFIs and Hidden Contagion. Part 4, History Rhymes, comparing LTCM and Archegos. And finally, Part 5, Preventing the Next Crisis.
Right, let's jump straight into Part 1, the $1 billion Vanishing Act. You see, the Archegos collapse wasn't just some isolated fluke. It sent these violent shockwaves ripping through the balance sheets of major global investment banks. Now, you're probably wondering, how on earth did one single family office do so much damage without anyone seeing it coming? Well, the answer comes down to these highly complex derivatives called total return swaps. Essentially, these swaps acted like a financial cloaking device. They allowed Archegos to secretly build up massive, incredibly concentrated positions in companies like Viacom CDS without actually owning the underlying stocks. And because Archegos spread these swaps out across multiple different prime brokers, they effectively blinded their own lenders. Literally, no single bank had the whole picture or knew the true scale of the risk. The fallout? Absolutely catastrophic. When stock prices took a dip and Archegos couldn't cough up the cash required to back those massive bets, their banks went into full panic mode. They were forced into a desperate fire sale, just aggressively dumping the underlying stocks to protect themselves. But of course, selling positions of that insane size tanked the stock prices even further. This meant the banks absorbed billions in devastating losses. I mean, Credit Suisse alone took a $5.5 billion hit. Moving on to Part 2, Anatomy of the Leverage Cycle. To really wrap our heads around the weapon that caused all this destruction, we have to look under the hood at the mechanical engine driving these crashes, and that is leverage. At its core, leverage just means buying an asset by paying only a tiny fraction in cash and then borrowing the rest, using that exact same asset as collateral. It's kind of like a mortgage, right? You put maybe 5% down to buy a house. Now, leverage is great for optimistic buyers because it lets them borrow heavily and bid asset prices up. But man, it is a brutal double-edged sword. If the asset's price turns south, that tiny little sliver of cash equity gets wiped out almost instantly. Economist John Ganakopoulos mapped out exactly how this plays out in what he calls the leverage cycle. It goes like this. First, you have this boom phase where optimistic borrowing artificially pumps up asset prices. Everyone's happy. But then, boom, a scary shock hits, some piece of bad news that spikes uncertainty. Suddenly, those nervous lenders start demanding way more collateral, which triggers margin calls. This violently forces highly leveraged optimists to sell, which leads to cascading fire sales. That drives prices down even more, sparking even more margin calls. It's just a mechanical, downward spiral of doom. And you can actually see proof of this theory everywhere when you look at the historical data, specifically the violent spikes in average repurchase haircuts or margins during past market crises. During boom times, lenders are totally relaxed. They ask for almost no collateral, so margins sit incredibly low. But the exact split second a crisis hits, those margins spike violently upward. This mechanical tightening instantly chokes off market liquidity right at the exact moment everybody needs it the most. Okay, Part 3. NBFIs and Hidden Contagion. So we have to ask, who exactly is doing all this highly levered borrowing today? Well, the answer is hiding in the shadows of the financial system. We're talking about non-bank financial institutions, or NBFIs. These include hedge funds, pension funds, insurance companies, and yeah, family offices. Now, traditional retail banks are strictly monitored. They have to hold heavy capital buffers. But these private market entities, they face way lighter regulatory scrutiny. Because of that, their massive use of leverage can stay completely invisible to regulators and honestly to the broader markets themselves. And the sheer size of these entities is just staggering. NBFIs currently make up nearly half of the entire global financial system's assets. Half. So while they do provide really vital funding, their massive footprint means their hidden vulnerabilities are a systemic threat on par with the traditional banking sector. It's a hidden fragility that genuinely puts everyday pensions and savings right in the crosshairs. So here's the really crucial point. These concealed risks are almost entirely invisible when times are good. During a boom, different assets look wonderfully diverse and totally unconnected. But as risk experts constantly point out, when a stress scenario hits, the correlations between all these different assets suddenly shoot up. Everything drops at once. What looked like a totally safe, diversified portfolio rapidly transforms into an explosive, highly concentrated snowball of risk. Actually, we saw this exact dynamic play out beautifully, well, terribly, during the March 2020 pandemic dash for cash. Now, government bonds are supposed to be the absolute safest, most liquid assets on the planet, right? Yet, because highly leveraged NBFIs were all scrambling to unwind their positions and hoard cash at the exact same time, even those ultra-safe haven markets faced severe liquidity stress. Bid-ask spreads saw massive spikes, signaling near total market dysfunction. Let's look at Part 4, History Rhymes, comparing LTCM and Archegos. Now, if this story of the Archegos meltdown is sounding a little familiar, well, that's because this kind of financial contagion is part of a repeating cycle. Let's compare Archegos to the infamous 1998 collapse of long-term capital management, or LTCM. So LTCM was run by literal Nobel laureates. They used crazy 30-to-1 leverage to scrape tiny profits off bond pricing differences. Fast forward, Archegos used derivative swaps on media stocks. The players changed, the financial instruments changed, but the lethal combination, extreme, hidden leverage, violently unraveling through systemic margin calls, remained exactly the same. Back in 1998, it literally took a $3.5 billion rescue orchestrated by the Fed just to stop the dominoes from crushing everything. At the end of the day, both of these funds relied on exploiting tiny market deviations using massive amounts of borrowed money. And both ran headfirst into a really harsh truth. It's perfectly summarized by this quote from our sources. Capital is only as patient as its least patient provider. You see, you might fully believe an asset's price is going to bounce back eventually, but guess what? Your lenders do not care. At the very first sign of an external shock, they pull their support, they demand their margins, and they force you to liquidate. End of story. Finally, Part 5, Preventing the Next Crisis. So with all that said, how in the world do global regulators stop these invisible dominoes from toppling the broader financial system the next time we get a scare? Well, regulators like the Financial Stability Board, the FSB, are zeroing in on a few core structural vulnerabilities. They're targeting that dangerously high and hidden leverage we've been talking about. They're heavily scrutinizing liquidity mismatches, which is basically when funds hold illiquid assets but have immediate cash liabilities due tomorrow. And finally, they are actively addressing weak risk management and trying to pierce right through the unregulated opacity of entities like family offices. To actually build this into actionable policy, the FSB is pushing some pretty aggressive new measures. For starters, they want to cap off-balance sheet leverage. They also want to dramatically improve data collection so that these massive risks can't just be hidden across multiple prime brokers anymore. And crucially, they are demanding frameworks to ensure funds actually hold sufficient cash buffers, meaning real liquid cash. This way, they can actually survive the inevitable margin calls of the next scary shock without resorting to those market-destroying fire sales. But listen, as we've explored in this explainer today, the leverage cycle is an incredibly enduring mechanical feature of human optimism. As long as there are markets, there will be leverage. So as this cycle inevitably continues its rotation into new and increasingly complex assets, we have to constantly ask ourselves, where does the next heading risk lie? What invisible domino is quietly being set up right now, just waiting in the shadows for the next scary shock? Thanks so much for joining me today. Keep your eyes on the margins and stay curious.